The system did not collapse in a single night. There were no sirens, no closed bank doors, no official announcement. Markets still opened every morning. Screens still glowed green and red. Money still moved. But liquidity, real liquidity, was already dead. What replaced it was something artificial, manufactured, a simulation held together by debt, leverage, and confidence that could not be audited. Trillions were printed without resistance. Interest rates were pushed to zero, then below it. Risk was rebranded as stability, and the world was told this was normal, necessary, permanent. Yet behind this illusion, one institution behaved very differently. While the public was taught to trust digits on a screen, JPMorgan quietly did the opposite. They did not buy promises. They did not buy derivatives. They did not buy exposure. They hoarded metal. Hundreds of millions of ounces of silver, cold, heavy, undeniable, were removed from the open market and locked away, bar by bar. Serial number by serial number. Over 600 million ounces. No press conference, no explanation, just silence. And silence in finance is never accidental. Because if the system was truly stable, if paper money was sound, if counterparty risk was imaginary, if markets were honest, there would be no reason for the largest bank on earth to stockpile an amount of silver so large it rivals national reserves. Banks are not survivalists. They do not act on ideology. They act on information. And information told them something was coming. The first crack appeared after 2008, when the world learned that money could be created faster than value, that debts could be socialized while profits remained private, that the price of failure was not bankruptcy, but expansion. Since then, every crisis has followed the same script: print, inflate, deny. Each cycle larger than the last, each rescue more extreme, each temporary measure quietly made permanent. But here is the contradiction no one was meant to notice. If money can be printed infinitely, why would anyone need silver? Why would JPMorgan, the core dealer of the dollar system, choose a metal that cannot be created by keystroke, cannot be rehypothecated endlessly, cannot be wished into existence by policy? Because silver does not lie. Silver does not default. Silver does not need confidence. Silver settles accounts when trust disappears. And trust was already evaporating. Under the surface, the financial world had become a hall of mirrors. The same assets pledged again and again. Paper claims stacked on top of paper claims. Futures, options, swaps. Contracts referencing metal that did not exist in deliverable form. A market built on ratios that only worked as long as no one asked for the real thing. And JPMorgan understood a rule as old as banking itself. When too many claims chase too little reality, the ones holding reality win. So they began to withdraw. Not publicly, not emotionally, methodically. As regulators looked the other way, JPMorgan accumulated silver through quiet channels, warehouse transfers, exchange deliveries, settlement flows that never made headlines. To the outside world, silver prices stayed subdued. Volatile, yes, but contained, manageable. That was the signal everyone misread. Low prices were not proof of abundance. They were proof of control. Because the most dangerous shortages do not announce themselves with spikes. They reveal themselves with silence. And all the while, the world's monetary foundation grew weaker. Sovereign debt ballooned beyond any realistic path to repayment. Interest rates became weapons, not tools. Entire governments relied on rolling obligations forward, hoping tomorrow would forgive today. In such a system, cash is a liability. Promises are fragile. Only assets without counterparty risk remain standing when the music stops. JPMorgan did not hoard silver because they love the metal. They hoarded it because they fear what comes next. A moment when liquidity vanishes, not gradually, but suddenly. when paper claims race toward physical settlement, when vaults, not screens, determine who survives. And when that moment arrives, the question will not be price, it will be access. Because silver, once removed from circulation, does not return easily. Supply chains fracture, mines lag, inventories vanish faster than models predict, and when the doors close, they do not reopen on schedule. JPMorgan knew this before anyone else. That is why they moved first. That is why they moved quietly. And that is why 600 million ounces are no longer available to a world that still believes money is infinite. The system is still running, but something fundamental has already ended. Empires do not collapse without warning. They leave footprints, not in headlines, but in behavior, in quiet decisions made by those closest to power, in what they choose to keep when everything else is being spent. History does not record these moments as alarms. It records them as patterns, visible only in hindsight. And the pattern is always the same. When money weakens, the elite do not argue. They reposition. In ancient Rome, silver coins were slowly diluted with base metals. The denarius lost its weight, then its credibility. Officially, nothing was wrong. Markets still functioned. Soldiers were still paid. But behind the scenes, senators and merchants stopped holding currency. They hoarded metal, land, grain, anything that could not be altered by decree. The empire did not fall because people panicked. It fell because those who understood the system exited first. Centuries later, Weimar Germany repeated the lesson with brutal clarity. Banknotes multiplied until they became fuel for fireplaces. Workers were paid twice a day. Prices changed by the hour. The public clung to cash because it was familiar. The insiders converted paper into gold the moment it appeared. By the time the collapse became obvious, the transfer of wealth was already complete. Then came 1971. The dollar severed its final link to gold. Officially, it was temporary, a technical adjustment, a necessary evolution. In reality, it was the birth of pure fiat, money backed by confidence alone. Once again, the same behavior emerged. Central banks spoke stability while quietly increasing gold reserves. Governments told citizens to trust paper while settling international trade in hard assets. The rules applied differently depending on where you stood in the hierarchy. This is the pattern. First, currency debasement. Then, loss of trust. Finally, flight to real assets. Not by the masses, but by those who see the ending early. The public always arrives last, because collapse is not an event, it is a process. And JPMorgan's silver hoard fits perfectly into this lineage. They are not inventing a strategy, they are inheriting one. Every financial empire reaches a point where complexity exceeds honesty. JPMorgan's behavior signals not confidence but preparation. Preparation for a phased transition, a moment when the old rules no longer function, when paper systems strain under their own abstractions, when settlement matters more than valuation. Because history shows this too. In every monetary reset, those holding physical assets do not need to explain themselves. They do not need to negotiate. They wait. And when the system reorganizes, their assets are repriced, not upward gradually, but suddenly, violently, without permission. The public is told this is unforeseeable, a black swan, an accident. But history disagrees. The signs are always present. Debt expanding faster than productivity. Interest rates trapped by their own weight. Markets dependent on intervention rather than price discovery. These are not anomalies. They are late-stage indicators. And in late stages, elites do not speculate. They consolidate. JPMorgan silver is not a bet on inflation or deflation. It is a bet on continuity of power through disruption. Because when currencies fail, institutions that hold real assets do not disappear. They re-emerge stronger, having absorbed the shock while others argued about theory. This is why hoarding always precedes collapse. Not because collapse is guaranteed, but because optionality is priceless. Silver gives optionality. It functions outside credit systems, outside digital rails, outside policy reach. It cannot be frozen, diluted, or rewritten. Empires understand this instinctively, which is why every empire nearing the end looks irrational to those still believing the story. Why would Rome debase its currency? Why would Weimar print endlessly? Why would the United States borrow beyond repayment? Why would JPMorgan hoard silver? Because the story is ending. And when stories end, only tangible things remain. This is not conspiracy, it is recurrence. And recurrence does not ask for permission. Two markets exist for silver. Only one of them is real. The first is the market everyone sees. Screens filled with charts, prices flickering by the second. Futures contracts rolling endlessly forward. Exchange-traded funds promising exposure without delivery. This is the paper market. It is liquid, fast, and enormous on paper. The second market is almost invisible. No flashing prices, no daily headlines, just weight, custody, and control. This is the physical market, and the distance between them is where the deception lives. For every ounce of silver that actually exists in vaults, dozens, sometimes hundreds of claims are traded against it. Contracts referencing metal that will never be delivered. Promises settled in cash, not bars. As long as no one asks for the metal, the illusion holds. But JPMorgan did ask. While the public was taught to trade silver as a number, JPMorgan focused on silver as an object. They did not accumulate exposure. They accumulated possession. Vault receipts, allocated bars, metal that cannot be rehypothecated without consent. This is the parallel no one wanted to confront. Retail investors were pushed into ETFs, structures designed for convenience, not certainty. Futures traders rolled contracts indefinitely, never intending to stand for delivery. Even industrial users trusted just-in-time supply chains built on uninterrupted flows. Meanwhile, JPMorgan was draining the reservoir. The paper market told one story. Silver was abundant, replaceable, manageable. The vaults told another. Because paper silver multiplies effortlessly, physical silver does not. A futures contract can be created in seconds. An ETF share can be issued with a keystroke. But a silver bar must be mined, refined, transported, assayed, and stored. Time, energy, and capital are embedded in every ounce. This is why control matters more than price. JPMorgan understood that as long as they dominated the physical supply, they could tolerate volatility in the paper market. Price swings do not threaten power. Shortages do. And shortages begin not with spikes, but with withdrawals. Each bar removed tightens the system. Each ounce locked away reduces the margin for error. Eventually, the ratio between paper claims and physical metal reaches a breaking point. At that point, settlement becomes political. Who gets delivery? Who gets cash? Who is told to wait? The answers are never democratic. The public assumes markets are governed by transparency and rules. But in moments of stress, they are governed by access, and access belongs to those who prepared early. JPMorgan's silver hoard transformed them from participant to gatekeeper. They were no longer exposed to the market was exposed to them. This is why accusations of manipulation miss the deeper truth. Manipulation implies short-term intent, pushing prices up or down for profit. What JPMorgan executed was structural. By controlling physical inventory, they positioned themselves above price discovery. They could weather suppressed prices because they were not forced sellers. They could endure regulatory scrutiny because possession is not illegal. They played a longer game, a game where the end is not a higher chart, but leverage over an indispensable resource. Silver is not optional. It is embedded in energy systems, electronics, medicine, defense. Every attempt to electrify, digitize, and automate the economy increases dependence on a metal most people think is abundant. It is not. And when industrial demand collides with monetary demand, paper solutions fail. Contracts cannot power a grid. ETFs cannot solder circuits. Promises cannot replace atoms. Only metal can. This is the collision JPMorgan prepared for. The public lives in the paper world because it is easy, liquid, familiar. It offers exposure without responsibility. JPMorgan chose the physical world because it offers control. And control, in times of transition, is everything. When the parallel systems finally meet, when paper holders demand what only vaults can provide, the illusion resolves instantly, not gradually, not politely. One side is satisfied in cash, the other side inherits the future. JPMorgan made their choice years ago. The only question left is how many others will realize which market they are actually in before the door between them closes. At first glance, the explanation seems harmless. A hedge, a trade, a balance sheet position. That is the story allowed to circulate, but it does not survive scrutiny. No rational institution stockpiles hundreds of millions of ounces of silver merely to speculate on price. Not a bank whose core business is leverage, not storage. Not an institution with infinite paper tools at its disposal. This was never about return. It was about control. Silver sits at the fault line of the modern world. It is both ancient money and modern infrastructure, a relic of trust and a prerequisite for the future. This is the part rarely discussed. Every solar panel requires silver. Every advanced circuit depends on it. Every missile guidance system, every data center, every AI-driven device uses it in trace amounts that add up to strategic dependence. And unlike oil, silver cannot be substituted easily. Its conductivity, reflectivity, and antimicrobial properties are not theoretical. They are irreplaceable at scale. Yet the supply is fragile. Most silver is not mined for silver. It is a byproduct of other metals. Production cannot simply be increased by raising prices. Mines take years to open. Reserves deplete quietly. This creates a structural vulnerability, one that becomes critical in a world racing toward electrification, militarization, and technological competition. JPMorgan understood this before it entered mainstream discussion. They did not accumulate silver because they believed prices would rise next quarter. They accumulated it because they understood scarcity would eventually collide with necessity. And when that collision happens, price is secondary. Access is everything. In moments of resource stress, markets do not behave academically. They behave politically. Supply is rationed. Contracts are renegotiated. Governments intervene. Strategic stockpiles are prioritized. Those without metal receive explanations. Those with metal write terms. This is where the illusion of free markets dissolves. For years, silver prices were suppressed not by accident, but by design. A low price discourages mining investment. It keeps the public disinterested. It allows accumulation without competition. But suppression is not the end game. Accumulation is. Once enough metal is removed from circulation, the mechanism flips. Shortages emerge quietly. Deliveries stretch. Premiums detach from spot prices. And suddenly the paper market no longer sets the narrative. The physical holders do. This is the betrayal few are willing to name. The same institutions that benefited from paper dilution positioned themselves to survive its failure. The same system that taught the public to trust abstractions quietly rewarded those who rejected them. JPMorgan did not break the rules. They followed them perfectly. Rules written not in law, but in precedent. When resources become strategic, ownership outranks transparency. When systems reset, continuity favors incumbents. Silver is not just a commodity in this equation. It is leverage. Leverage over industries that cannot function without it. Leverage over governments that need technological sovereignty. Leverage over a transition that cannot pause. and leverage over a population still debating whether digital numbers are the same as real assets. This is why the hoard was built in silence. Because once the reason becomes obvious, it is already too late to compete. JPMorgan silver is not insurance against collapse. It is preparation for a world where collapse and innovation happen simultaneously, where old money fails, while new systems demand more resources than ever. In that world, those who control inputs control outcomes. That is the real reason. Not profit, not hedging, not coincidence. Power does not announce itself, it stockpiles. There is a moment every system reaches, not when it collapses, but when it stops pretending. When the rules still exist on paper, but no longer apply equally. When access matters more than price. When the question shifts from how much does it cost to who is allowed to have it. That moment is closer than most believe. Because silver is not being consumed slowly. It is being absorbed, pulled into solar grids, embedded in data centers, locked inside military hardware, disappearing into technologies designed to define the next century. And once silver enters those systems, it does not return to the market. Recycling lags, inventories thin, supply chains stretch. The metal does not vanish, but availability does. This is how shortages actually happen, not with empty shelves, but with closed doors. At first, nothing looks different. Spot prices still update, paper contracts still trade, analysts still argue about fundamentals. But behind the scenes, delivery timelines extend. Minimum purchase sizes increase. Premiums detach from benchmarks. The vault door begins to close. And when it does, price becomes irrelevant. Because price is only meaningful when supply is optional. In a constrained world, silver stops being something you buy. It becomes something you are allocated. JPMorgan understands this endgame. They do not need silver to be expensive. They need it to be unavailable to others. Because when physical scarcity becomes undeniable, institutions with inventory are elevated above markets. They become intermediaries, not participants, gatekeepers of continuity. At that point, the paper world fractures. Contracts are settled in cash. ETFs revise language. Force majeure appears where certainty once lived. The public is told the system worked as designed. It did, just not for them. This is the inevitability history never dramatizes properly. Resets do not arrive with warnings. They arrive with explanations, after the fact. People will ask how it happened, why no one stopped it, why the signs were missed. But the signs were not hidden. They were just inconvenient. A bank hoarding metal while promoting digital liquidity. A market awash in claims while inventories shrink. A world accelerating toward electrification while underinvesting in the materials it requires. These are not contradictions. They are signals. JPMorgan chose its side long ago. Not the side of price charts, not the side of public narratives, but the side of permanence. Because when the system redraws its boundaries, those holding real assets are not asked to adapt. They are asked to supply. And supply, in times of transition, dictates terms. The final truth is not that collapse is guaranteed. It is that preparedness creates asymmetry. Some will experience the reset as chaos. Others will experience it as consolidation. Silver is not a prophecy. It is a position. The vault does not care what you believe. It only cares what you can deliver. And when the door finally closes, the difference between promise and reality will no longer be theoretical. It will be locked in steel.